might ask the question, well, the Fed's going out and buying $2 trillion of securities. How do we pay for that? And the answer is that we paid for those securities by crediting the bank accounts of the people who sold them to us. And those accounts at the banks showed up as reserves that the banks would hold with the Fed. So the Fed is a bank for the banks. Banks can hold deposit accounts with the Fed, essentially, and those are called reserve accounts. And so as the purchases of securities occurred, the way we paid for them was basically by increasing the amount of reserves that banks had in their accounts with the Fed. Sometimes you hear that the Fed is printing money in order to pay for the securities we acquire. But as a literal fact, the Fed is not printing money to acquire these securities. And you can see it from the balance sheet here. The light blue line is basically flat. The amount of currency in circulation has not been affected by these activities. What has been affected is the purple area. Those are reserve balances. Those are the accounts that banks, commercial banks, hold with the Fed, and they're assets of the banking system and they're liabilities of the Fed, and that's basically how we pay for those securities. And so the banking system has a large quantity of these reserves, but they are electronic entries at the Fed. They basically just sit there. They're not in circulation. They're not part of any broad measure of the money supply. They're part of what's called the monetary base. But again, they're not. They certainly aren't cash. Then there are other liabilities, including treasury accounts and a variety of other things that the Fed does. We act as the agent, the fiscal agent for the Treasury. But the two main items you can see are the notes in circulation and the reserves held by the banks. Now, just one more comment on large-scale asset purchases. A lot of people don't make a very good distinction between monetary and fiscal policy. Fiscal policy is the spending and taxation tools of the federal government. Monetary policy has to do with the Fed's management of interest rates. These are very different tools, and in particular, when the Fed buys assets as part of a LSAP or QE program, this is not a form of government spending. It doesn't show up as government spending because we're not actually spending money. What we're doing is buying assets, which at some point will be sold back to the market, and so the value of that of those purchases will be earned back. In fact, because the Fed gets interest, of course, on the securities that we hold, we actually make a very nice profit on these LSAPs. What we've done over the last 3 years is transfer about $200 billion in profits to the Treasury. That money goes directly to reducing the deficit. So these actions are not deficit increasing. They are, in fact, significantly deficit reducing. So here's a picture of the sluggish economic recovery that we've had. The blue line in the graph shows the path of real GDP. The gray bar shows the period of the official National Bureau of Economic Research recession. You can see it begins in December 2007, and real GDP begins to decline during that period. In mid-2009, the recession is officially over, and you can see since then the blue line's been moving up as the real economy has been expanding. What you can also see, though, is a comparison here. What we did was we said, suppose that the economy had been recovering since mid-2009 at the same average pace as previous recoveries in the post-war period. And that average recovery is shown by the red line. And you can see by comparing that this recovery has been slower than the average recovery in the post-World War II period. It's actually even worse than that in a way because this was the most severe recession in the post-World War II period. And so you would expect, perhaps, that recovery might be a little quicker as the economy comes back to its normal levels. But in fact, it's been actually slower on average in terms of growth than previous post-war recoveries.